Dave, thank you for taking the time. I wanted to do this conversation with you because for us, when people speak about endowment style investing or sovereign wealth funds, uh, we take it for granted what this means because we've lived in that world. But I think people ought to really understand what are the requirements behind that style of investing. So people know it's long term. People get excited about it. It has an allocation to venture and private equity and other private funds and hedge funds. But managing that whole machine, there is a much more things that one needs to do. So let me sort of start by asking you the question. So you were inside an endowment, Stanford Endowment. You set up McKenna and Caitlin Fitzmyer, who's also came from University of Virginia Endowment. I came from the Sovereign Wealth Fund, and we all have we sat inside an institution that has different things to it. It obviously had to evolve, but there is a process. So could you maybe just describe to me again what's your takeaway from that style of investing, and what is required to pursue that style of investing?
Sure. Well, Hashim, I always enjoy these conversations, whether or not the camera's on, and and whether it's on the phone or video or in person. It's actually great timing thinking about endowment style investing because in the last week I've gotten the quarterly reports. The final numbers from the calendar year are in, and I'm reminded and investment committees are happening. I had one last week for University of Virginia's endowment and so forth. So I guess a few thoughts. The first is sort of, and you touched on this in the beginning of your question, what does it mean? At its basic level, of course, it is a style of investing that originated really David Swensen, who led the Yale Endowment from 1985 on to a couple of years ago when he passed away, was sort of the godfather of it. But it has a few elements. One is a asset allocation framework that spreads the amount of capital across a half dozen or more asset classes that behave differently from each other, and therefore manages the overall risk and return profile of the pool of capital over time. So you have some asset classes like venture capital that would be very, very volatile at times, but generate very high returns if you do them well. You'd have other asset classes such as fixed income that would play a very different role in the portfolio. And it all works together like a bit of a symphony, where you have different instruments and sections that play different roles. And those roles, depending on the climate, an up market, a down market, what have you, or certain economic scenarios, inflation growing, rates coming up, rates going down, etc., that symphony has to play through those environments. And the goal is to generate the highest risk-adjusted return. So it's not just the highest return, you have to be mindful of the up and down run over time. The idea at the end of the day, really where it came from was an architecture where that pool of capital has to pay out more or less about 5% of its size every year to fund some institutions or some other things. So the objective of the returns is to be able to pay out that liquid 5% a year to the recipient of that, to stay ahead of inflation, and then to make a little bit of a return on top of that. Other elements of it are that starting early on, it made heavy use of private or alternative asset classes. Alternative meaning alternative to the very traditional liquid stocks and bonds, equities, and fixed income. So venture capital, private equity, real estate, the use of long, short, and absolute return hedge funds, these became asset classes. And then lastly, in general, it's a belief that if you're good at what you do, you take your time, it's part art and part science. You can identify active managers to manage the majority of this portfolio. That's really the only alternative in the private asset classes. Private asset classes make up well over half of those endowment portfolios today. The largest two being typically now venture capital and private equity. So it's the pursuit of active management, heavy use of the alternatives, a framework that spreads the capital invested so that it rides out through up and down environments and produces over an intermediate to long term, steady set of returns that meet those return hurdles that are really driven originally from that payout number and a couple of building blocks on top of that. Just to feed maybe sort of some discussion, it's interesting. I haven't been on the inside of a couple of these institutions on boards and in a practicer of my core expertise is venture capital and private equity is a core and growing part of that. It's certain institutions in the endowment world have evolved quietly. Many of them have not. And I actually think, I have a variety of sort of observations on what I would say are sort of flaws or areas that the model hasn't evolved much at all and could evolve over time by the right institutions. And so, I don't look at the endowment. It's not monolithic. People practice it differently. I don't think the endowments in the US have all the wisdom. And I actually think many of them have not evolved and are losing an opportunity to do so. And others will, and I will gain some advantage of that. And then, of course, it spilled over into the commercial world starting about 20 years ago with a variety of managers, outsourced CIO, OCIO is the acronym for them. McKenna, my prior firm, was one of those. There were others that are bigger now and have grown more and have evolved their model more. So I'll stop there.
So evolving the model, now you caught my attention. So is this like 2.0 or 3.0? Could you comment on that?
Yeah, my observation would be, and part of this is structural and the way they're run, but I would say the criticisms or flaws of its application are that if you take a step back, these pools essentially are 100% illiquid in their structure to the recipient of the capital. They would, those practicing it would say, no, that's not true. We can get at X amount of the portfolio in X amount of time. But the reality is for the recipients, whether you're in an institution, like the University of Virginia, I sit on the law school board. Most of our assets are with the UVA Endowment, which is a phenomenal organization. We're only able to get that 5% payout and 10% in emergency. So, McKenna, my prior firm, or others like it, essentially are illiquid pools of capital in their entirety for the investors of that capital. That you can get a small amount out, 5% plus. There are redemption features that behave like a largely fully illiquid pool of capital. And yet the returns, so if you judge it based on that, the returns in many cases are appallingly low. I was looking at one set of returns over every time series, 3, 5, 10, 15 since inception. We're generating net returns of 6.5 to low 7s. That's not acceptable for a fully illiquid portfolio because, as we know, we can go and create a similar fully illiquid pool of capital and get very high returns, 2 to 3 times that number, 4 times that number if it's purely privates. right? And there are ways of building an endowment to have full liquidity for more than half. And so, like, I guess the criticism would be taking that entire approach on all those asset classes, burdens it with full illiquidity. It burdens it with significant fees and carry because of active management. And so my view is where it needs to evolve is a more intelligent assessment of where can I use ETFs? Where is active management not worth the effort and the fees involved and the illiquidity? And I believe that there's, can be this doesn't happen at established organizations, because if you're the hedge fund guy, if you're the real estate guy, if you're the fixed income person that runs that portfolio, you want your 15 managers, and you're going to think there's some interesting guys doing an X, and you're going to build your domain in your portfolio. That's not, in most cases, that's not the right answer for the overall pool. If you're the public equity, I looked at a set of returns yesterday also, a third of the portfolio was in public equity, and it trailed on every time series significantly the benchmark index, and you could own that benchmark index for 3 basis points. You can own the 75-25 or the 60-40 for 3 basis points and have it fully liquid. So my criticism of the model applied in some places are like institutionally, they're not going to do that. They're not, the head person or the board's just not going to say, look, we actually don't need these 6 managing directors because, enough's enough after 15 years of negative alpha. We should just own the, MSCI ACWI index, or we should have a third of it, anchored by an ETF, a 75-25 ETF. So that would be my sort of high level criticism of the practice of the endowment model that hasn't changed much, and in my view, should change.
So my take on that is that I mean, you said at the beginning that the endowment is supposed to earn a return higher than inflation, which is logical for it to preserve the purchasing power and grow that capital. And in the old days, I remember the one of the objective would be OECD inflation plus 3%.
Right.
And when that was set, it was coming off a high inflation number. Now, in what we've experienced over the past 20 years, up to 2022, inflation was 2%. So 2% plus 3% were an easy walk. But the way I would probably approach what you're saying is, I would probably say, you know what, I'm going to charge you an illiquidity premium. So in other words, like if you want to do private equity, 500 over public equity. And I'm going to also get you to focus on an absolute return number.
Right.
So this way you deal away, first of all, as you said, now you start getting into, do I want to pay, like, how much equity do I have in my portfolio? How much equity do I want in the portfolio? Where am I getting that equity from? Is it from private equity? Is it from venture? Where am I getting the biggest alpha in? Is it in private equity? Is it in venture, public equity? I'm not getting any of that. Why do I need it? And then what other managers bring me a return stream that's not correlated? So you really now think about the real value added in that. But I guess, from what you described and what I'm saying, it's totally disrupting that old regime where you have different departments, different silos, and you have a whole industry catering to each one of them.
Yeah, correct. Look, your first comment's spot on, but I would say you can think about it in a very simplistic way. If your entire pool is effectively illiquid, then the entire pool should be delivering an illiquidity premium that's quite substantial, right? Like, the pool could be just venture, or it could be the entire endowment pool. But if the illiquidity profile to the recipient is the exact same or very close, right? You would say that a 6.5% return just doesn't cut it. It should be 10 or 12%, right? Versus like if that venture capital illiquid pool is generating a 23% return, you'd say, yeah, that does the trick, right? That there's a margin of safety that's delivering value for that illiquidity. The reality is these, the high returning private asset classes, once they hit maturity, more or less have a payout that can be mid-single digits to double digits over the long haul. That's no different than that endowment payout. And yet, some of those private equity might get you sort of net low to mid-teens, and venture would get you net 20 plus. It's paying you for that illiquidity with a payout that's not significantly different than, the payout that you'd require from the overall pool. So I guess the observation is the entire pool, if it behaves in an illiquid fashion, isn't delivering on the appropriate illiquidity premium.
Okay, and so now we know one thing which you highlighted is the fact that they are so they produce the 5%, and then 90% is illiquid in one shape or another. Now, does that worry you if these guys have to somehow need to do a shift, or to come up with the money for one reason or another?
Say that again.
Okay, so I am a university endowment. My circumstances change.
Yeah.
And I need more payout.
So, most of those institutions have similar rules. The one that I was just back for last week, basically there's a formula that produces the annual number that they're going to get as the standard payout. We say 5%, there's a smoothing formula and stuff, but it's more or less 5%. Some of these institutions also charge little taxes on those payouts, right? But in any event, it's around 5%. If you look at the contracts that govern, basically at a university that might have a business school and a law school and, English department and an athletic department, those are like sub pools, and they'll have sort of a contract with the parent endowment management company, even though they're part of the same university. But that contract might say, in severe instances, you can get at 10% of your capital. Usually there's some warning, and I would be shocked if anybody allows more than 10%, right? So it tends to be, and there's some guardrails on there and so forth. That's really what you're looking at, right? Now, that even in severe instances like 2008 or, the pandemic quarter, people don't make use of that because there's cash balances and there's other. So, I don't know of an instance where a school had to, I haven't looked, around the country. I don't know of an instance offhand where somebody pulled the ripcord and needed that. Mostly it makes boards feel comfortable that in a 100-year flood, they could get it a bit more money, but it never, that never becomes necessary.
And now managing the commitments. So they need to make an annual payout of 5%, and then they have also money that's going to be called by the managers during the year. Right.
So it's all these institutions have to do that, right? They're good at it. They have data on capital calls in different environments and distributions that go back decades and, hundreds of data points. And so, so those models are quite good. They occasionally get stretched, right? If you looked at, 08, 09 and those years, or more recently, they get stretched because we go through these boom and bust periods where typically in a run up, the high returning and most illiquid asset classes are doing extremely well. So take the last, 5 years, 8 years, just take one of those. Venture capital did extremely well. Everybody wants more venture. So it's hard to get money into venture the right way. And so you'll have it's like a step function where there's the rush to commit more and more. Those are illiquid and unfunded commitments, right? And then there's somebody takes the punch bowl away from the party and people are sitting on much higher levels of unfunded commitments. Those are legal commitments that they need to make if they're asked for the capital. Now, the reality is the venture funds, for instance, don't invest much during those periods, so they're not calling that capital. But the LPs, the limited partners, are on the hook for that. So back to the modeling of cash flows, you have to be careful. You have to stress test these models to make sure that you have the liquidity if asked for these capital calls. Typically, the sources of liquidity are a fixed income portfolio that might be high single digits to low double digits. There'll be a couple of points of cash. These portfolios have a bit of a sort of even in quiet times that you get a couple points of just distributions that come out of your portfolio. And then public equities, liquid public equities are the other area where you don't want to sell those equities in a down market, but they're a source of liquidity if you need it. Some organizations will have lines of credit lined up for 5 or 10% of their pool of capital to use in a pinch. You model all this stuff out and you stress test it and you say, okay, if I go through a 2008 markets down 50%, if I model no distributions, if I model lots of calls, that's typically not going to happen when the world's crazy, but like, let's model it out. Like how quickly can I get at enough cash to pay those calls? And at what point am I going to have to start selling equities? And also these organizations will have sort of a, in the event of a crisis, break the glass kind of thing. Like, okay, first you get liquidity from here, then you get liquidity from here, then you get liquidity from there. I would say that's an area that I think this approach has excelled. These things have survived the test of severe market conditions. Not everybody has. Some people end up selling secondaries of private commitments made. So there are periods of panic. In 08, 09, a lot of endowments and other institutions like that for 6 or 9 months unloaded their some of their private equity commitments in great managers. They just had to. The boards panicked a bit, and I guess if at the time we had more or less recently started McKenna, we were the buyers of those, and those ended up being good investments. Other institutions were as well.
So all what you described requires a process, discipline, people, alignment of interest, and all of that. Could you just shed light on this, as in somebody starting a new endowment or even a family office? What are the things that they should be made aware of? Because you hear now of like an endowment coming up or a family office that's coming up, and they want to do all of that stuff, and when you look through at what they're doing, you wonder whether they have gone through all the requirements for them to make that jump.
Yeah, well, like anything else, first of all, let me take a step back. The beauty is you don't need a lot of people. Some of the best, take Yale for many years, ran with one, brilliant head person and a very small number of, people that worked with him, small number as in single digit people. More and more, the systems available, the use of advisors and services that'll help you do your job are are available and quite cheap, right? So you don't need a lot of people. But what I'd say is you need people that know what they're doing. Like anything else, you don't want, if you break your hip, you're not going to want a skin surgeon to do the operation. They still have the doctor title. They may have gone to Harvard Medical School, but you want somebody who knows exactly what they're doing, has been through up and down cycles. Another one, just on the up and down cycles, I was just commenting to somebody yesterday on this. Time moves on and we sort of live in our little bubbles. But take today, like basically you need a 40-year-old person or older to have seen the 2008 crisis, right? Like there's a whole generation or two of younger professionals that they've known nothing but an more or less up to the right set of markets and rates coming down, right? And if you look at significant inflation, you got to go way back. You need somebody with a lot of gray hair or no hair to have seen those markets. Not that many people saw the late 90s, 2000, and the 2000 to 2004 market in addition to 2008, right? And so you might have a brilliant 38-year-old, but they've known one market. They haven't been tested, and they can't draw learnings. I saw, I can't remember this quote. It was a great little quote, but it's basically like to draw wisdom, you need to have been through tough times. So you need a crisis environment and you need to have burnt your hands on some stuff or seen others around you. So back to the staffing point, you need somebody who knows what they're doing. You don't need a lot of people. You ideally need somebody who has been through, I would say, more than one crisis, or certainly seen more environments than what we've had over the last 15 years. And then, there's other things that are helpful, a governance framework, a set of basic policies that can't be too constraining, but do have some constraints. Basic things like, a cap where you can't make too big of a bet without a check and balance system, right? You can't commit 15% of the pool to one thing without a significant check and balance system. Typically, those might be like 2% of the pool to a manager or an investment, things like that. So you need some governance in there. You need some oversight, whether it's from a board or another, like the principal of the capital and so forth. Those are some of the basics that I think serve a purpose in all organizations.
What you just said about that you want to be we want to have someone who have seen different cycles. Throughout my career, I found my best learning was through interacting with people who either have seen different cycles or have gone through studies to think through what could happen. And it's almost like became a mentorship. So if I was, building a family office now for myself, or I'm building an endowment, the first thing probably I would require is to really have people who have experience, be in one shape or form, have a say in what's going on. Because this way, the younger ones can get to build, but then they would run the idea by the guys who have seen different cycles. So it's almost like a perfect AI system. Somebody,
Yeah.
you go and check with somebody what would have happened if these things happen.
Yeah, I think that's
versus
exactly
just dive in.
Yeah. No, I think that's exactly right. I mean, what I like about it is, you know, back to the point that you don't need a lot of people. I actually think individuals who are both top-down thinkers, asset allocators, for lack of a better word, right? And bottoms up manager selectors, married in the same person, are, you know, probably the rarest, but actually the most valuable. Essentially, Dave Swenson was that, remarkably so. But if you look at Dave Swenson's, you know, the people that he trained, you know, the sort of Tiger Club, so to speak, some of those best investors came out of that. Like, and to the point that you don't need many. Paula Volent, who worked with David for years, then ran a small endowment, billion-ish plus, Bowdoin College, more or less by herself with maybe an analyst or two. Her set of returns, if you look back over year in and year out for 15 plus years, were the best. They beat the bigger entities. And she, you know, so she basically had to do everything. She had to pick every manager in every asset class. She had to run the top down as well. She had a tough board, Stan Druckenmiller and others on there. So, like, if you, I guess the takeaway is, if you're a family office or an institution, it's possible to get it all in one or a small number of people. And in fact, some of the best outcomes are that. It's hard to think of other businesses managing so much money where that's the case, right? You think of, you need an army of professionals and analysts and expensive systems and everything. It doesn't necessarily need to be the case. Sometimes smaller is better. Sometimes more concentrated portfolios are better. And they can be done with relatively limited resources, as long as those limited resources are really, really skilled.
Yeah, and then, you know, you bring in AI. I find from my previous experience, you know, the big organizations, you end up having people not talking to each other. Like, there's
Yeah.
so much knowledge that is spread around so much. The challenge is how to get them to speak to each other. And naturally, because it's so big and it's a different incentives, you don't have that benefit. Maybe that's probably, you know, like the version 3.0, or like, I remember when we moved from ADIA to ADIP, that was 2.0, and trying to get everybody inside an investment committee and argue things out and what have you. Naturally, there's certain people whose voice was stronger, so they, versus others who did not want to participate as much. And then when I went out to set up Liwa, I really wanted to, you know, small is better, and I wanted to break down that you know, your culture whereby there is somebody who comes in, you really digest all of this, and then you go and discuss it. And now with AI, if you think about it, man, that's like, just as you were describing to me earlier on, how, you know, with AI, you get now to be, your productivity quadruples, if you think about it. You can
Yeah, bringing the AI in is an interesting facet, because I guess, you know, what I was referring to earlier when I said the endowment approach, for lack of a better word, should evolve, where, you know, I think my point there was, don't take the same heavy fee active management approach to the entire portfolio. Pick your shots, I guess is what it says, right? Like, maybe half the pool is more or less passive, cheap, liquid, because you can concentrate the returns, the bang for the buck, so to speak, in the other part of the portfolio. And that liquid have actually more than adequately, generates enough of a return to free up the ability to excel in the areas, the asset classes, the applications that matter. AI brings a similar facet in, right? If you don't have to write a quarterly report, or you have an AI module that can save you dozens of hours in different facets, frees you up for the time, the hours, the trips that really matter, where you can really move the needle. What's exciting is as the technology evolves, is where it can inject efficiency into these organizations and the people involved. And then, to your point, you were saying earlier, it's up to those people to actually apply that extra time wisely in areas that are going to make the most difference in the outcome of their job, their role, the pool of capital that they're managing.
Exciting. I am excited about the fact that there is volatility. So with volatility, active versus passive is going to differentiate itself. I'm excited about all of this AI. So there is no limitation. We can do so much stuff. It, in fact, it can retool me faster and bring in the young generation and get them up to speed much faster.
Yeah.
And I think somebody in the middle, they need to also kind of join that party. Dave, that was insightful. Thank you.
Always great having a conversation with you, Hashim.
All right. Thank you.
All right.